Good morning. Couple announcements before we get started. We'll start with the exam locations. Hopefully you're got it now. It has been all the same places all semester. So if your last name begins with A through L, Chemistry Lab Building C130, M through Z, Norman 137. Again, if you're online, make sure you check with the online business department for the place and time of your exam. Again, final exam this coming Monday, August 6th at 7 p.m. If you had sent me an email about having the business law exam at the same time, you should have received an email with the time and location of the makeup exam. If you did not receive it, make sure you send me an email today. A few more announcements before we finish up on Chapter 12. Again, the practice exam is posted online. The office hours for the remainder of the semester are posted online. There are a good number of office hours scheduled for Monday. So if you have any last-minute questions before the exam, make sure you take advantage of those office hours. Usually a lot at this time I get questions on how should I study for the final, because remember the final exam is comprehensive. So a few things about the final exam. First, 40 questions just like your previous two exams. It's divided approximately even. And what I mean by that is approximately half new material, half old material. So half the material comes just from chapters 9, 10, and 12. There's approximately 6 to 7 questions from each of those chapters. Then there's approximately 2 to 3 questions from each chapters from 1, 2, 3, 5, 6, 7, 8, and Appendix C. So how should you study? Well, first I recommend you study for the new material, so that since that's half of the questions on the exam. So study the new material, make sure you get that down. Once you have that down, go back and study, refresh the old material, look first at what you knew the best, okay? Because that's where you're going to know you're going to get those points. So you don't want to miss things that you knew once before, okay? Those are the easiest areas to kind of just refresh your memory and get those questions right. So look back at what you knew the best first, refresh that information, then time permitting, go back and do questions from the areas that you struggled with. One thing that students struggle with is just the fact that they did well in the quizzes because it was only one chapter. You kind of knew what concept was addressed because you knew what chapter it covered. Then when they get to the exam, they have a harder time because everything is mixed all together. One thing you can do for that, especially since it's the end of the semester and hopefully you don't really need your notes anymore, is to kind of cut up your notes, cut up the problems from the slides in your notes and mix them all up so that you can do them again, but you just pick a question and you don't necessarily know what chapter it comes from. Okay, that's kind of the best way to prepare for an exam where it's kind of everything all at once. Let's see, what else? Quiz grades are now posted on Sakai, so make sure you look at the class website, look at what your total quiz points is. Now the quiz points on Sakai is your total points, so it doesn't show the grade that you received on each quiz, it just shows your total points. So it's rounded up if you had 0.5 or above, rounded down below 0.5. So make sure you check that, make sure it agrees with what you think it should be. If you have any problems, if you think that your quiz score is recorded wrong, send me an email, let me know what you think it should be and what it is. Keep in mind, as stated in the syllabus, you are required to use your UF email address in my accounting lab. That's how I get the grades out of my accounting lab into Sakai. If you did not use your UF email address, you did lose 5 points. Okay, so if the quiz grades that you show are 5 points less than what you think they should be, Did you use your UF email address? That could be the issue. Hey, are there any questions? One more thing before we get started. I've been getting a lot of questions on any curve. And I said for each exam I looked at the median score, and the median score didn't really need any curve at that time, so I hadn't looked at kind of the grades all together. After the final exam, I will look at the grades all together and look at whether a curve is needed. I know a lot of people are kind of at the deadline of deciding whether they're going to drop the class. Right before class, I kind of took all the grades out and looked at total points up to this date and didn't have enough time to really say, well, this would be the exact curve. But I did look at it enough to say, if there was no final exam and if today was the end of the semester, right now it looks like there would be at least a slight curve on each grading category. So just keep that in mind. For the higher grades, much less of a curve. For C and below, right now it would look like it was a pretty decent curve. So probably I expect after the final there will be some sort of curve on the final grades. Again, don't know exactly what that will be until the final exam grades are in and I have everything. Okay, any questions? Okay. Well, the good news is I just happened to have this file opened on one of my computers, so I was able to save it to a jump drive, and we do have our notes since the computer apparently still broken. But so here's where we left off in class on Tuesday. We were talking about the statement of cash flows. We're talking about the indirect method for the operating activity section. And here's the problem we're going to go through. Okay, this is the problem from the back of your book. I'm going to put some additional information up on the board. So this is exercise 12-20A, and it wants us to prepare a cash flow statement using the indirect method for the year ended December 31st, 2010. It says the income statement of Newbury Company shows the following amounts. Okay, so we have net income. Okay, that's $68,900. We have depreciation expense. Okay, $26,000. Okay, then we have some additional information. So first, acquisition of plant assets was $212,000. Of this amount, $160,000 was paid in cash, $52,000 by signing a note payable. So purchase plant assets. Okay, this was for $212,000. $160,000 in cash. The remainder for notes payable. Then proceeds from the sale of land totaled $27,000. Sell land. Since this is proceeds, we know this is cash. Okay, C, proceeds from issuance of common stock totaled $80,000. Payment of a long-term notes payable of $17,000. The last thing, payment of dividends of $13,000. In addition to this information, we see the comparative balance sheet for 2009 and 2010. From looking at the comparative balance sheet, we can look at the changes in our current assets and our current liabilities. So with the comparative balance sheet and the additional information they've given us, we can prepare the whole statement of cash flows. So first we're going to start off with figuring out what the change in each of these current assets and current liabilities are. Okay, so change in cash, $19,200. Accounts receivable decreased by $17,000. Inventory decreased by $61,000. Prepaid expenses increased by $700. Okay, then down to our current liabilities, accounts payable increased by $11,000, looking the wrong way, and accrued liabilities decreased by $81,000. Once we have these changes from our balance sheet, then we can go through the steps first of our operating activity section. So in our operating activity section, using the indirect method, we start out with our net income. So net income was $68,900. Step 1 to adjust net income is to add back any non-cash expenses. So depreciation, amortization, depletion. Well, in this problem, we have depreciation expense of $26,000. Okay, that depreciation expense reduced our net income. It's not cash, so we need to add it back. So we add $26,000. Okay, the next step is to reverse the effects of any gains or losses on the sale of our plant assets. Okay, well, in this problem, we sold land for $27,000. Okay, the problem didn't tell us we had a gain or a loss, so we're assuming no gain or loss, so that doesn't apply here. Okay, once we get through that, our last step is to adjust for the change in our current assets other than cash and our current liabilities. Okay, so if we go back to our comparative balance sheet, we show that accounts receivable decreased by $17,000. Our general rule for our current assets is we do the opposite, as an indirect relationship. So if the account decreased, that means we need to add that $17,000. Okay, then we had a decrease in inventory of $61,000, so we add that decrease in inventory. And we had an increase in prepaid expenses of $700. Okay, we need to subtract that increase. Why do we subtract that increase? Well, if our prepaids increase, that means we've paid more for these prepaid expenses than we incurred in expenses. So the actual expenses are what show up in our net income. Here we're looking at cash. Since we've paid for more of these than we incurred in expenses, we had more of a cash outflow. So subtract off that $700. Then we look at our current liabilities, and our current liabilities have a direct relationship. So we do the same thing. The current liabilities increase, we add. If the current liabilities decrease, we subtract. So we have an $11,000 increase in accounts payable that we need to add, and an $81,000 decrease in accrued liabilities that we subtract. So when we add all these up, we get net cash provided by operating activities of $102,200. So this is a net cash inflow from operating activities. It's an inflow because it's a positive number. This ended up being a negative number. It would be a net cash outflow. You would be paying cash. Okay, now our investing activities. Okay, we said operating activities you can prepare using either the indirect or the direct method. For investing and financing activities, you're just going to list out all the cash flows associated. So these are basically going to come from the extra information that we put here. So we have an inflow from the sale of land, so plus $27,000. Then we need to subtract the purchase of the plant assets. Notice, however, that we purchased plant assets that cost $212,000, but we only subtract off $160,000 because we only subtract off the portion that is cash, since this is the statement of cash flows. We only have a cash outflow from this purchase of these plan assets of $160,000. Okay, so this means we have net cash used or a net cash outflow from investing activities of $133,000. Okay, then the last section, cash flows from financing activities. We're going to have an inflow from the issuance of common stock. We got $80,000 cash when we issued that stock. Subtract off the payment of the notes payable. We're assuming here the whole $17,000 is principal amount because they didn't tell you any part of that was interest. Remember, if there's any part that's interest, that would be part of operating activities, not financing activities. Okay, subtract off the payment of dividends of $13,000. Okay, add those up, we get net cash provided or a net cash inflow from financing activities of $50,000. Okay, then when we put it all together, so we have that net cash provided by operating activities, inflow of $102,200, outflow from investing activities of $133,000. Okay, the net cash inflow from financing activities of $50,000. If we add those together, we have a net increase in cash of $19,200. Okay, notice how that net change in cash reflects the change in cash from our comparative balance sheet. When we looked at the comparative balance sheet, we expected a net increase in cash of $19,200. And that's the same amount that shows up here. If we take that net increase in cash and add it to the cash balance from December 31st, 2009, we get the ending cash balance December 31st, 2010. Any questions? Okay, few easy questions now. How does depreciation appear on the cash flow statement using the indirect method? A is a subtraction in the operating section, B is an addition in the operating section, C subtraction in investing, or D addition in financing. Okay, this is depreciation. Okay, we're using the indirect method. Okay, if we were using the direct method, would this show up in the statement of cash flows anywhere? No, because it's non-cash, right? But since we're using the indirect method and that depreciation expense is included in net income, which is the starting amount for the indirect method, you have to add it back in the operating section. So the answer is B. Okay, which of the following best describes the relationship between a change in a current liability and the operating section using the indirect method? Remember, a current liability has a direct relationship. Okay, you do the same thing. An increase in a current liability is added to net income. Next question. A company sells a plant asset with a book value of $15,000 at a loss of $3,000. What amount would be reported in the investing section of the cash flow statement? Remember, we report the cash proceeds or the cash amount that we receive from the sale. Okay, so remember when we calculated the gain or loss on the sale. Gain or loss was the difference between the cash received and the book value. So if we received more cash than the book value, we had a gain. It was a positive number. We received less cash than the book value, we had a loss. So this problem says we have a loss of $3,000. We're trying to calculate the cash received because that's what goes in the statement of cash flows. And we're told that the book value is $15,000. So if we solve for cash here, our cash equals $12,000. So we have an inflow of $12,000. Don't let the loss confuse you there. It's still an inflow because someone's going to pay us $12,000 for this plan asset. It's a loss because this plan asset has a book value that's more than that $12,000. Hey, which of the following would be reported as a non-cash financing and investing activity? A stock dividend. Yes, that would be reported. Again, you're looking at things that would have been reported in the financing or investing section if it involved cash. So if this was a cash dividend, it would show up in the financing section. Okay, stock dividend, so no cash involved, so it's reported in non-cash financing and investing. B, purchasing a building by issuing stock. Yes, if you purchase the building for cash, that would show up in the investing section. Since here you're issuing stock, shows up in non-cash financing and investing. C, acquiring land by issuing a long-term notes payable. Yes, if you purchase land for cash, it would show up in investing activities. Therefore, it's going to show up in this non-cash financing and investing. So the answer there is D, all of the above. The next question. Beautiful America Transportation began 2010 with accounts receivable, inventory, and prepaid expenses totaling $58,000. At the end of the year, they had a total of $55,000 for these current assets. At the beginning of 2010, they owed current liabilities of $20,000, and at year-end, current liabilities totaled $32,000. Net income for the year was $12,000. Included in net income were a $2,000 loss on the sale of land and depreciation expense of $8,000. Show how BAT should report cash flows from operating activities using the indirect method. So again, indirect method, very systematic. We go through our steps. Start out with our net income. So they tell us in the problem that net income for the period was $12,000. Okay, step 2, add back any non-cash expense. So here we have depreciation. So they tell us in the problem that depreciation expense for the period was $8,000. So plus $8,000. Step 3, reverse any gains or losses on the sale of long-term assets. So it says included in net income was a $2,000 loss. So we have to add back that loss. Okay, step 4, adjust for the change in our current assets. Current assets, indirect relationship. So if they increase, we subtract. If they decrease, we add. So here we had our current assets that totaled $58,000 at the beginning of the year, $55,000 at the end of the year. So we're going to add that decrease in our current assets. That decrease was $3,000. Then we look at our current liabilities. Current liabilities have a direct relationship. So if they increase, we add. If they decrease, we subtract. So here we have current liabilities of $20,000 at the beginning of the year, $32,000 at the end of the year. So we're going to add that increase in current liabilities. Okay, when we add that all up, we get a positive $37,000. So that means a net cash inflow from operating activities of $37,000. Any questions? Okay, next question. This is an old exam question. Allen Company's 2009 income statement reported total revenues of $850,000, total expenses including $40,000 of depreciation of $720,000. The 2009 balance sheet reported the following: accounts receivable, beginning balance $50,000, ending balance $40,000. Accounts payable, beginning balance $22,000, ending balance $28,000. Therefore, based only on this information, the 2009 net cash inflow from operating activities was. Okay, so first we have to calculate what our net income is. Okay, net income is our revenues minus our expenses. So revenues of $850 minus our expenses $720. So we get net income of $130,000. So our operating activities, we start out with our net income. And our next step is to add back any non-cash expenses. So here we have depreciation expense. Okay, so it tells us in the problem depreciation is $40,000. Okay, then we look for any gains or losses on our long-term assets. We don't have any. So we look to adjust for change in our current assets. So here accounts receivable went from $50,000 to $40,000. So we have a decrease in accounts receivable. Okay, current assets, indirect relationship, we add decreases. So we add $10,000. Okay, then we have accounts payable, beginning balance $22,000, ending balance $28,000. So we have an increase in accounts payable. Okay, direct relationship, we add any increases. So plus $6,000. So we have positive $186,000, which means a cash inflow of $186,000. Any questions on the indirect method? Okay, now we're going to move on to preparing a statement of cash flows by the direct method. Okay, so what is the direct method? Well, basically the direct method is just listing out all your cash inflows and all your cash outflows. Okay, it's preferred by the FASB, the Financial Accounting Standards Board. Why? Because it provides clear information about the sources and uses of cash. Okay, think about when we see this reconciliation of net income to net cash from operating activities. You can't really tell what's happening there, right? I mean, just by looking at it, you can't see how much cash you received from customers, how much cash you paid to your suppliers, how much cash you paid for your different expenses. You just see the bottom line. Okay? The direct method, therefore, provides more information to the user because it provides all the sources and uses of cash. It shows how much you received from customers, how much you paid for expenses, and so on. Even though this is preferred by the FASB, it's used by very few companies. Why? It takes more computations. Since we use the accrual method of accounting, okay, we're kept in this accrual system where we're recording income. Okay, we don't have the records, we don't record these transactions based on cash basis of accounting. Therefore, it takes computations to get to each one of these items in the statement of cash flows. Okay, however, it only affects operating activities. Remember, investing and financing activities, we always use the direct method. Okay, so what are some operating cash flows under the direct method? We went through some of these. Cash receipts mostly is going to come from collections from customers. It might also come from cash received for interest, cash received from dividends. Okay, payments, lots of different things here. Cash paid to suppliers, cash paid to employees, cash paid for interest, cash paid for income taxes, okay, any type of expenses that you have, this shows the cash payment for them. So how do you actually arrive at these amounts? Well, we've seen some of this before, and some of this will be a review of last class when we went through kind of the explanation for why we adjust things the way we do in the indirect method. Okay, remember last class we kind of went through what I called the proof as to why the change in current assets have an indirect relationship. You subtract increases, add decreases, and current liabilities have a direct relationship. You add increases, subtract decreases. Okay, same idea here. That's how we got to these cash flows. So the main thing for these is to know what you start with and then what you have to adjust. Whereas under the indirect method, when we are trying to look at the bottom line, the cash flows from operating activities, so we are just adjusting all current assets and all, except cash, and all current liabilities. When we're looking at the direct method and you want to calculate one component of it, you need to know what you adjust for. So cash receipts from customers. Okay, you start with sales revenue, and you're going to adjust for the changes in your accounts receivable. Okay, same idea here when we talked about the indirect method. Okay, accounts receivable is a current asset, so it has an indirect relationship. So you start with sales revenue. Okay, you add decreases in accounts receivable, you subtract increases in accounts receivable. Again, what is the reasoning behind that? Because you start with your income statement number, your sales revenue. If accounts receivable decreases, that means that you had a net increase in cash that you collected. You collected more cash from your customers than you made in sales. So you need to add that amount to the sales revenue. Okay, if you had an increase in accounts receivable, that means that you had more sales than you collected in cash. Okay, we can go through kind of the explanation for this again. So given some information, let's say you had beginning accounts receivable of $10,000, ending accounts receivable $30,000, and you had sales for the period of $100,000. Okay, so you see here that you had an increase in accounts receivable of $20,000. You know, an increase means you collected less cash than the sales that you made. Okay, so think about what's going on here. Well, first, we could do it kind of the shorthand way. As we see here, we start with sales revenue, $100,000. Okay, then we adjust for the change in our accounts receivable. So our accounts receivable increased by $20,000. Accounts receivable is a current asset, so if it increases, we subtract that increase. So we calculate that we receive $80,000 of cash from customers. If you go through kind of the logic behind it and look at your T account, okay, you start with accounts receivable of $10,000 and accounts receivable of $30,000. You know, when you recorded your sales, debited your accounts receivable for $100,000, credited sales revenue. So when you recorded your sales revenue, that increased your accounts receivable by $10,000. Now you're looking for the amount that goes there, the cash collected. Because cash collected is you debit cash, credit your accounts receivable. So what amount do you need to credit your accounts receivable for so that you have an ending balance of $30,000? So 10 plus $100,000 minus $30,000 means you have $80,000 credit. So again, cash is $80,000. And we could go through that again for the decrease, but we did that in the last class. Okay, same idea for interest revenue, cash collected for interest. Start with your interest revenue. Okay, adjust for the increase or decrease in interest receivable. Any questions on cash receipts? Okay, now cash payments. We start with probably the harder one of the cash payments, and that's cash paid to suppliers. Okay, we start with cost of goods sold, and we have to adjust for the changes in two different accounts, inventory and the change in accounts payable. Why? What does cost of goods sold represent? Again, cost of goods sold is the expense that you report on the income statement. What does that represent? Not the expense to maintain inventory. Cost of goods sold is the expense, is the cost of those goods that you actually sold during the period. Okay, so that's what shows up on your income statement, the cost of the goods that you actually sold during the period. What are you trying to calculate here? You're trying to calculate here the cash you paid to your suppliers to purchase the inventory. So how do you adjust for it? Well, one, that's why you need the change in inventory. Did your inventory increase or decrease? Okay, that's going to tell you whether your cost of goods sold represents, more items or less items than you purchased during the period. Okay, then once you adjust for the inventory, you also need to adjust for the change in accounts payable. Because you might have purchased that inventory, but again, we're looking for cash paid for that inventory. If your accounts payable went up for the period, well, maybe you got inventory items, but you haven't paid for them yet. Okay, and again, we're looking for the cash paid for these inventory items. Where on the other hand, if your accounts payable decreased, okay, maybe you didn't purchase as much inventory, but you paid for amounts that were recorded in a prior period. Okay, so you have to adjust for both of these. Now the shorthand method here that I do in the slides is a little bit different, I will warn you, than what your book does. And the reason for that is your book kind of goes off of a different kind of explanation for the direct method and the indirect method. And I've found in semesters past that really confuses students, because you get to the direct method for these payments and you're kind of adjusting whether you increase or decrease the change. And it's already, I think, sometimes somewhat confusing to say, well, current assets, indirect relationship, you do the opposite. You add decreases, subtract increases, current liabilities, direct relationship, add increases, subtract decreases. Then if you get here and try to kind of reverse that, it sends people's heads spinning. So, kind of don't look at your book maybe so much for this. The difference that I do versus the book is your book starts out with cost of goods sold as a positive number. It's a positive expense they view it at. And then you have to adjust the changes. However, if you just take your cost of goods sold and make that a negative number because it's an expense, you can use those same general rules to adjust for the accounts that you have to adjust for. So as long as you know whatever number you start with, so remember when we looked at the cash received, so cash received from customers, cash received for interest, we started with sales revenue or interest revenue. Those were positive numbers because they're a revenue. They increased your net income. When we start with an expense, when we're looking at the cash payments, we start with an expense. We need to start with a negative number because that expense reduced your net income. So let's go through kind of an explanation as to why this is and how you would actually calculate this. Okay, so start with the cash paid to suppliers. So let's say we have beginning inventory, $20,000. Okay, ending inventory of $10,000. Okay, beginning accounts payable of $10,000, ending accounts payable $30,000. Okay, and let's say we have cost of goods sold that we reported that's for the period of $200,000. Okay, so a few things here, and there's a couple different ways to solve this. So we see inventory decreased by $10,000. Okay, and accounts payable increased by $20,000. So if we use the shorthand way, where we just take cost of goods sold, adjust for the change in inventory, adjust for the change in accounts payable. So we start with cost of goods sold, $200,000. Again, the key is we have to make this a negative number since it's an expense. So we start with negative $200,000. Okay, then we adjust for the change in inventory. So inventory is a current asset. Okay, it decreased. Current assets, indirect relationship. So if it decreased, we have to add that decrease. Okay, if you think through it logically, what does that mean? Well, this $200,000 represents the inventory that you actually sold for the period. We're trying to get cash paid for inventory during the period. If our inventory decreased during the period, that means we sold more inventory than we purchased during the year. Okay, so that's why we need to add this $10,000 back, because we're reducing this negative number. And kind of if your mind is spinning right now and you're not getting kind of all the explanation, you really don't have to get all the explanation as long as you can kind of get the steps. I go through the explanation because for some students that is how they can't just memorize kind of the process, they need to know the reasoning behind it. Okay, now let's look at accounts payable. So accounts payable increased by $20,000. Okay, if it increased by $20,000, we're going to add this $20,000. Again, why do we add the increase in accounts payable? Well, what happens when accounts payable increases? That means that we bought some things on credit. We had a net credit transaction. So we were able to purchase inventory and we didn't pay for all of it in cash. So again, by adding this $20,000, it reduces the negative number. So it reduces the cash payment. So if we start with negative $200,000 plus $10,000 plus $20,000, we get a negative $170,000. So that means cash paid to suppliers is $170,000. Since this is a negative number, we know it's a cash outflow. All of these should be cash outflows because we're trying to calculate cash payments. Okay, couple other ways to look at this. So if we look at kind of how we did over here with the T account, look at what we're calculating. We can look at the T account for inventory and accounts payable. Okay, so we have beginning inventory, $20,000, ending inventory, $10,000. Okay, beginning accounts payable, $10,000, ending accounts payable, $30,000. And again, think of what we're trying to calculate. We're trying to calculate the cash payments for our purchases, right? Cash payment for our purchases. How do we figure out how much we purchased during the period? Where are you going to look at to determine purchases for the period? You're going to get that from your inventory account, right? All right, because remember our general cost of goods sold equation, which we'll see a different way to calculate this. Cost of goods sold equals our beginning inventory plus purchases minus our ending inventory. Okay, when we record our cost of goods sold for the period, what else is part of that journal entry? Well, when you record cost of goods sold, you debit your cost of goods sold. All right, and we said cost of goods sold for the period was $200,000. Debit your cost of goods sold, your credit your inventory. So when you record cost of goods sold, you credit your inventory. So you're missing an amount here. What amount is that? That is your purchases, right? You debit your inventory account when you make purchases. So you debit your inventory. What is your credit to? Well, if you pay for them in cash, you credit cash. Pay for them on credit, it's accounts payable. Okay, so you're looking for the amount that goes there in order to get your purchases, which is then going to go down here. So if it's $20,000 minus the $200,000 on that side plus X equals 10. Okay, you're calculating the amount of purchases you made for the period. We calculate that, right? We get purchases of $190,000. Okay, then we take that amount, that goes over there. Okay, because again, when we purchased inventory, we credited accounts payable. That goes into our accounts payable T account. And then again, our bottom line, what we're trying to calculate is how much cash we paid for this inventory. Okay, so that's a debit to our accounts payable. When we make the payment, we decrease our accounts payable, credit our cash, which is what we're trying to solve. So if we have $10,000 plus $190 minus this $30,000, we get $170. Again, same amount that we calculated the shorthand way. Why do I go through all those T accounts? Just multiple ways to solve the same problem. Some people like T accounts and journal entries. They understand how kind of the transaction works. They don't want to have to memorize, add, or subtract. So that's why we go through the T accounts. If kind of the two T accounts are too much for you, kind of knowing the relationship between the two T accounts, what was the whole reason for doing the inventory T account? The whole reason for doing the inventory T account was to calculate the amount of purchases, then put that purchases in accounts payable. Another way to solve for purchases is just to use your cost of goods sold equation. Okay, we had all the information except purchases given to us in the problem. So cost of goods sold, $200,000. Beginning inventory is $20,000. We're going to solve for purchases. Ending inventory, $10,000. So here, when we solve for purchases, we get $190,000. And then again, once we solve for purchases, we can look at that accounts payable T account. Beginning balance $10,000, ending balance $30,000. Purchases for the period of $190,000. So then we solve for what goes in the debit to accounts payable. We know the debit to accounts payable is the amount of cash you paid. So that's $170,000. Any questions? Okay, so 3 different ways to solve cash payments to suppliers. If you're looking at the cash payments for operating expenses, okay, cash paid for your operating expenses, you start with your operating expenses. Again, you'd start with a negative number. Okay, adjust for any changes in prepaids, any changes in accrued liabilities. Okay, cash paid to employees. You're going to start with your salaries expense, then adjust for the change in salaries payable. We could go through a whole explanation of those two. I think we've probably beat that dead horse, huh? Maybe, maybe not. So we'll leave that off. Okay, cash paid for interest. Start with interest expense. Adjust for the change in interest payable. And cash paid for income taxes. Start with income tax expense. Adjust for the change in income taxes payable. And I'll leave all kind of the proof behind that off in the hopes that maybe we have time at the end for questions on anything or questions on the practice exam. Again, key to these is to remember that that expense number, if you're just doing kind of the shorthand where you start off with the expense and adjust for the appropriate accounts, that expense number needs to be a negative number. Okay, the next thing, I think last thing we're going to do in this class is free cash flow. What is free cash flow? Well, free cash flow is basically the amount of cash a company has to go for anything that they might encounter, any investment that they might want to make. So investors want to know how much cash the company has free for opportunities that might present itself. Okay, so that's going to be your net cash provided by your operating activities minus any cash payments earmarked for investments in plan assets or any other types of investments. Any questions on Chapter 12 before we start the end of chapter questions? Okay, the statement of cash flow's indirect method reports depreciation expense as an addition to net income because depreciation, A, causes an inflow of funds for the replacement of assets. No, depreciation doesn't have anything to do with the replacement of assets. B, reduces reported net income of the period but does not involve an outflow of cash for that period. That is true. The answer is B. Next question, direct method. The accounts payable account has a beginning balance of $12,000 and an ending balance of $10,000. We purchased $50,000 of inventory on credit during the month. How much did we pay our creditors during the month? So this is a pay our creditors, pay our suppliers question. So that kind of long drawn out question that we just did. Okay, however, this question worked a little bit differently. The question told you the amount of purchases during the period. Okay, so if we look at our T account for accounts payable, it said we had beginning balance of $12,000. Okay, ending balance for the period was $10,000. So our accounts payable decreased by $2,000. And then we had our purchases during the period. Purchased $50,000 of inventory. Debit our inventory for $50,000. This would be our entry. And our accounts payable for $50,000. So we're looking for the amount there, the amount of cash that we paid. That's going to be the debit to accounts payable, credit to cash. So $12,000 plus $50,000 minus the $10,000 gives us $52,000. Cash paid to creditors, $52,000. So again, if you kind of wanted to do it shorthand, purchase $50,000. Start with negative 50. Okay, a little bit different wording because we're not starting with cost of goods sold, which is the normal case. The reason for that is they jumped ahead, told us what purchases were. Okay, and accounts payable decreased by $2,000. So subtract that decrease. So we have negative $52,000. Next question. Amanda Company reported income tax expense of $300,000. Beginning income taxes payable was $25,000, while ending income taxes payable was $15,000. What amount of cash was paid for taxes? So again, you can do your shorthand. Okay, you start with income tax expense and adjust for the change in income taxes payable. So income tax expense $300,000. Again, it's an expense, so we need to start out with a negative for the $300,000. It says beginning income taxes payable was $25,000, ending $15,000. So income taxes payable decreased by $10,000. Income tax payable, current liability, it decreased. So we subtract that decrease of $10,000. So we get negative $310,000. Again, if we go through the T account, our beginning balance in income tax payable, $25,000. Ending balance, $15,000. And we reported income tax expense of $300,000. So when we report the expense, we would have increased our income taxes payable. And we're looking for the amount that goes there. Because when we pay our income taxes, we decrease our income tax payable and credit our cash. So $25,000 plus $300,000 minus the ending balance of $15,000 gives payments of $310,000. Next question. Birch Company reported proceeds from short-term borrowings of $2.5 million, proceeds from long-term borrowings $6.8 million, repayments of long-term borrowings $3.5 million, interest payments of $780,000, repurchase of treasury shares $500,000, cash dividends declared of $1.1 million. Net cash flow from financing activities equals. So we're just going to go through this problem. Financing activities direct method. Go through this problem and say what shows up in the financing activities section, what doesn't. Okay, proceeds from short-term borrowings, $2.5 million. It means you borrowed money, got $2.5 million. Okay, so that's a cash inflow from financing activities. Proceeds from long-term borrowings, $6.8 million. Doesn't matter if this is short-term or long-term borrowings of whether it goes into financing activities or not. No. Any borrowings show up in financing activities. So this is a cash inflow of $6.8 million. Repayments of long-term borrowings, $3.5 million. Okay, that would be a cash outflow. So minus 3.5. Interest payments of $780,000. Is that included here? No, interest payments, part of operating activities. A repurchase of treasury shares, $500,000. Okay, that's part of financing activity. Since we're repurchasing it, be a cash outflow, so minus that $0.5 million. Cash dividends declared of $1.1 million. Is that included? Be careful here. Okay, it doesn't say paid, it just says declared. Okay, remember we're talking about the statement of cash flows. Statement of cash flows only cares about dividends paid. Okay, it would have to say dividends declared and paid, or just dividends paid. Since it's declared, not included. We haven't paid it yet. So we add all these up, we get a positive 5.3. So it's $5,300,000 net cash inflow. Next question. The financial statements for World Company showed the following. Cost of goods sold, $525,000. Then shows changes for merchandise inventory, accounts receivable, accounts payable. Wants to know cash paid for merchandise. So first, the shorthand method of solving this problem. So we start with cost of goods sold, negative $525,000. And then our chart tells us to calculate cash paid to suppliers, take our cost of goods sold, adjust for the changes in inventory and the change in accounts payable. Notice how we also see here the change in accounts receivable. That is just extra information. For these problems, make sure you know for the exam that just because something is listed doesn't mean you need it. You need to know what you need to adjust for. Okay, so we look here at inventory. Inventory went from $45,000 to $56,000. So we have an increase in inventory of $11,000. Okay, do we add or subtract the increase in inventory? Subtract. Okay, current assets, okay, indirect relationship, we subtract. Okay, then we adjust for accounts payable. We have beginning balance $37,000, ending balance $42,000. So we have an increase in accounts payable. Okay, add or subtract that increase. Add. So we add, what was it, 5,000. So if we take negative 525 minus 11,000 plus 5,000, we get negative 531,000. It's negative, so it's a cash outflow. So the answer there is C. Okay, we could also go through the method we did over there. Look at our cost of goods sold equation to solve for the amount of our purchases. 525 equals our beginning inventory of 45,000 plus purchases that we're going to solve for minus ending inventory 56,000. So we calculate purchases 536,000. Okay, then we look at our accounts payable T account. We had a beginning balance 37,000, ending balance 42,000. We made purchases of 536,000. So we're looking for the amount that goes there. Calculate this as 531,000. Any questions? The next question. The 2009 income statement for McGrath Corporation showed the following. Net income $140,000, depreciation expense $30,000, accounts receivable increase $8,000, prepaid expense decrease $5,000. Wants to know cash flows from operating activities. So again, step one, we start with our net income. Net income here, $140,000. Step two, add back any non-cash expense. Here we have depreciation. So plus 30,000. Look to see if we have any gains or losses that we have to reverse. Here there's no gains and losses. So we move on to the change in current assets or current liabilities. Okay, so we have accounts receivable increase of 8,000. Okay, so we need to subtract off the increase. Okay, then we have prepaid expense decrease of 5,000. Prepaid expense is an asset, so if it decreases, we need to add it. So 140 plus 30 minus 8,000 plus 5, get a positive 167. Next question. Robert's company sold equipment for $250,000, purchased a building for $6,500,000, sold short-term investments for $280,000, and repaid a notes payable for $2,300,000 plus $230,000 of interest. Now asking for net cash flow from investing activities. Okay, so start at the top. Sold equipment, $250,000. Okay, that's part of investing activities. Sold it, so it's a cash inflow, so positive $250,000. Purchased a building for $6,500,000. That's part of investing activities. You purchased it, so it's negative because it's a cash outflow. Sold short-term investments for $280,000. That's part of investing activities. You sold it, so it's a cash inflow. Repaid a notes payable for $2,300,000. It's the principal amount that would show up in financing activities, and then the $230,000 would show up as operating activities. So this is all the investing activities we have. So when we add it up, we get negative $5,970,000. Negative, so it's a cash outflow. So the answer is D. Last question. Lab Industries, Inc. issued $50,000 of bonds, paid cash dividends of $8,000, sold long-term investments for $12,000, received $5,000 of dividend revenue, purchased treasury stock for $15,000, and purchased new equipment for $19,000. The net cash flow from financing activities would be, so again, start at the top, issued $50,000 of bonds. Okay, that's a cash flow from financing activities. So plus $50,000. Paid cash dividends of $8,000. We paid, so that's part of financing. It's a cash outflow, so that's negative. Sold long-term investments for $12,000. That would be part of investing activities. Received $5,000 of dividend revenue. And that would be part of operating activities. Purchased treasury stock for $15,000. That would be a cash outflow from financing activities. And purchase new equipment for $19,000. That would be part of investing activity. So we add these up, we get a net cash inflow, since it's positive, of $27,000. Any questions over Chapter 12? No? Any questions now in general of anything that we discussed? Any questions for the final? No questions. You guys are ready. Okay, do you want to go over at least some questions or start going over the practice exam? Sure? Okay. So if you haven't done the practice exam and you don't want to go over some of these questions, turn off the tape or leave class. Okay, for those that are here, are there any questions that you specifically want to go over?
I haven't run across any problems yet, so
Okay.
I'm most of the way through it.
Okay, so we'll just start at the beginning then and see what we have time for. Okay, so 1, amortization of a discount or premium on a held-to-maturity investment affects all of the following except. Okay, so remember what happens when you amortize a discount or premium. Okay, you're going to adjust the investment account because this is an investment, so you didn't record that discount or premium. You're going to record the investment account directly. So first, when you purchase that bond, so at purchase, when you had a discount, let's say this was a $10,000 bond issued at 95. Okay, you would have put this investment on the books. 9,500 credit cash. And if this was a premium, let's say it was again that $10,000 bond at 105. So you would have put this investment on the books at 10,500, credit cash 10,500. Again, at maturity, each of these bonds are going to pay $10,000 to the purchaser. So on maturity, the entry that you're going to want to record as the purchaser is debit cash for $10,000, credit investment for $10,000. Okay, the investment for either one of these situations isn't on the books right now at $10,000. So we have to have a way, in the case of a discount, to increase this investment account to $10,000. In the case of the premium, decrease to $10,000. So for the discount, for our interest, we're going to debit cash for the amount of interest that we receive. Okay, in this case, we need to increase the value of the investment. So we're going to debit the investment account and then credit interest revenue. In the case of the premium, and we debit cash, how much we receive. But now we need to decrease this investment count down to $10,000 eventually. So we're going to credit the investment and then credit interest revenue. Okay, so when you amortize this discount or premium, it adjusts the investment account and affects the amount of interest revenue that you record. Okay, there. So the actual question, amortization of a discount or premium on a held-to-maturity investment affects all the following except. So A, interest revenue of the investor. Yes, because by amortizing this investment, in the case of a discount, it increases the amount of interest revenue. In the case of a premium, it decreases the amount of interest revenue. B, retained earnings of the investor. Since you're affecting the amount of revenue that you record, you affect the amount of retained earnings. C, amount of cash received when the interest payments are made. No. Remember, interest payments, cash received here is based on that stated rate of interest, That doesn't change. Okay, D, carrying value of the bonds on the investor's books. Well, again, by adjusting that investment account, you adjust the carrying value. So the answer there is C. The next question, salary expense on the income statement was $183,200 for the year ended December 31st, 2010. The salaries payable account. Make it bigger. There. Okay, so salary expense on the income statement was $183,200 for the year ended December 31st, 2010. Salaries payable account decreased by $19,230 during the same period. The amount of cash payments to employees for the year was. Okay, so again, this is one of those examples that we just did where you can kind of do the shorthand way or the long way through the T account. So shorthand way, start with the salaries expense. Okay, it's an expense, so you need to start with a negative number, so $183,200. Then you adjust for the change in salaries payable. Salaries payable decrease. Salaries payable is a current liability, so if it decreases, we subtract. So minus $19,230. So we figure this out, we get negative $202,430. So the answer there is C. We looked at this T account. Okay, I know here this question didn't tell you beginning and ending balance, but you just need to make up whatever numbers that you want so that the ending number decrease by $19,230. So if we start with $19,230 and say our ending balance is 0, or you could have started with $29,230, ended with $10,230. Okay, whatever makes it decrease by $19,230. Okay, then you have your salaries expense. Okay, so when you recorded our salaries expense, we would have debited salaries expense for $183,200, credited salaries payable. And you're looking for the amount that goes there, the amount that you decrease your salaries payable, because that would have been a debit to salaries payable and a credit to cash, which is what you're trying to solve for. So $19,230 plus the $183,200 is $202,430. Next question. Char Daniels, controller, has the following items. It's asking you to calculate inventory turnover. So inventory turnover is your cost of goods sold divided by your average inventory. Okay, so cost of goods sold here, $180,000. Okay, beginning inventory, $85,000, beginning inventory, $85,000, ending inventory, $65,000. So add those amounts, divide by 2. So we get 180 divided by 75,000. We divide this out, we get inventory turnover of 2.4. Number 4, Morton Corporation purchased equipment for $46,000. They also paid $1,200 for freight and insurance while the transit equipment was in transit. Sales tax amounted to $850. Insurance taxes and maintenance for the first year of use was $1,000. How much should Morton Corporation capitalize as the cost of the equipment? Remember, you capitalize all costs to get the equipment to usable condition. So we start off with the purchase price, $46,000, and we just go through all of those items and say, can we use the equipment or not? Can't use it, it goes into the cost of the equipment. So they paid $1,200 for freight and insurance while in transit. Since it's in transit, we can't use it yet. So we add that $1,200. Sales tax of $850. We have to pay sales tax to get the equipment. And maintenance for the first year, $1,000. Well, that's after we can use it, so that $1,000 does not get included. So the cost is $48,050. Okay, next question. Company started the year with $400 of supplies. During the year, the company purchased additional supplies costing $1,600. There were $800 of supplies on hand at the end of the year. An adjusted trial balance prepared at the end of the accounting period will show the following balance in supplies. Well, what does an adjusted trial balance show? An adjusted trial balance shows the ending balance. Well, here the problem told us there were $800 of supplies on hand at the end of the year. So the answer is simply 800. Next question. An owner makes an investment of cash into the business. This transaction would include. So if the owner makes an investment in cash, again, we're looking from the company's perspective. So we're going to debit cash because the company is receiving cash. When an owner makes an investment, the company is going to give common stock to the investor. So we're going to credit common stock. Okay, 7. Which of the following transactions would increase total assets? Okay, you could go through and just kind of think about it, or you could go through and write the journal entries for these transactions, see if it increases total assets. So 1, borrowed cash on a notes payable. You borrow cash, you're going to debit your cash for, what was it, $80,000. Credit notes payable for $80,000. Okay, well here, cash of $80,000, that's an asset. Okay, notes payable, liability. So that increases our total assets. Okay, 2, provided services on account, $10,000. It's on account, so we debit our accounts receivable, $10,000. Credit our service revenue. Okay, well, we debit accounts receivable, so that's plus our assets. We credit service revenue. That's plus stockholders' equity. So here we have another increase in total assets. Okay, 3, receive cash from a customer as payment on account. So we debit cash for $8,000, but it's payment on account. So we need to credit accounts receivable for $8,000. So here we have plus an asset, but then we have minus an asset. Okay, so no effect on total assets here. Last one, received a utility bill, $1,200. So you receive the bill, so you're going to record the utility expense. Doesn't say you pay it, so it would be accounts payable or utility payable. So when you record utilities expense, that's minus stockholders' equity. Record the payable plus the liability. No effect on assets. So 1 and 2 is what increases total assets. So the answer is A. Number 8. Thunder Corporation had a beginning balance in net plan assets of $220,000. During the year, they purchased $60,000 of new plant assets. Depreciation expense for the year was $30,000, and there was a net gain on the sale of plant assets of $3,000. The ending balance in net plant assets was $170,000. What is the cash received from the sale of the plant assets? Okay, the best way to solve this is look at the T account for net plant assets. Okay, so beginning balance $220. Okay, they purchased $60,000 during the year, so that's going to increase our plant assets. Recorded depreciation of $30,000. Okay, we're going to use that net gain in a minute once we calculate book value. And ending balance was $170,000. So what affects our plant assets? Well, we have our beginning balance. We add any additions. And we subtract the depreciation, subtract the book value of any asset sold. That gives us our ending balance. So we're missing this amount here, which is book value of assets sold. So we need to solve for this book value. So 220 plus 60 minus 30 minus the ending balance of 170. We get book value of assets sold of $80,000. Okay, this question asks for cash received from the sale of plant assets. So remember how we calculated our gain or loss. Gain or loss is cash received minus the book value. So here the problem tells us that we have a net gain of $3,000. So we're going to solve for the cash. Book value we just calculated is 80. So cash is $83,000. So we received a $3,000 gain, so $3,000 more than the book value. High Times Corporation owns 300 shares of Low Tide Company's common stock. Low Tide has 1 million shares of common stock outstanding. Low Tide Company is that answer is B, investee. Remember, investor is the person or corporation purchasing the stock. Okay, the companies whose stock it is the investee. 10. The method of accounting that records the impact of a business transaction as it occurs is the accrual method. That is a loud noise, whatever it is. Okay. 11. The allowance to adjust investments to market account has a current credit balance of $950 after adjustment. Available for sale investments have a current market value of $15,000. What is the carrying value of the investment? Remember, available for sale securities, every time you adjust to the current market value, you're going to record this adjustment to this allowance to adjust investments to market. If you can't kind of remember what it is, if you add or subtract, if it has a debit or credit balance, think of what losses and gains have a balance of. Okay? Oh, well, see, I did this, and you don't even have to do this. Why? Because it says in the problem, available for sale investments have a current market value of $15,000. You could use that credit balance of $950 in the allowance account to determine if this was only a 1-year-old investment, how much it costs. But now the carrying value is just the current market value. So I'm trying to make it more complicated. The answer is just B, $15,000. Okay, 12. On January 2nd, 2010, KJ Corporation acquired equipment for $260,000. The estimated life of the equipment is 5 years or 40,000 hours. Residual value $20,000. What is the balance in accumulated depreciation on December 31st, 2011? KJ Corporation uses the straight line method. So straight line method, we take the cost of $260 minus the residual value of $20,000, divide by the useful life of 5 years. Get that we depreciate $48,000 a year. Purchase this on January 2nd, 2010, so we're going to record a full year's depreciation in 2010 and then 2011. Question asks for total accumulated depreciation as of December 31st, 2011. So take that annual depreciation of $48,000, multiply by 2, we get $96,000. 13. For accounting purposes, the business entity should be considered separate from its owners if the business is organized as a. The key to this question that it said for accounting purposes. For accounting purposes, due to the separate entity assumption or the entity assumption, all businesses are considered separate from its owners. So the answer there is D, any of the above. Okay, 14, Jenny's Lawn Service issued 100 shares of $10 par value stock and received a lawnmower with a fair market value of $2,500. The entry to record this transaction would include. So this is issuing stock for equipment. So here you need to record this equipment at the fair market value. So here the fair market value $2,500. You debit equipment for $2,500. Then you put the common stock on the books just like you would have if you had sold the common stock for $2,500. So credit common stock. Credit common stock for the number of shares times the par value. So it's 100 shares times $10 par. So credit common stock for $1,000. And then you're going to credit paid in capital in excess of par, capital in excess of par, or additional paid in capital for the difference. So you're going to have A, a debit to equipment for $2,500. Okay, B, a credit to paid in capital in excess of par, $1,500. C, credit to common stock for $1,000. So the answer there is D, all of the above. Page 15. The following data is provided for last year. Net income $210,000. Current receivables and prepaid expenses increased by $10,000 and $2,000 respectively. Current payables decreased by $8,000. Under the indirect method, the cash flows from operating activities would be. So you start out with your net income, so that's $210,000. Okay, no non-cash expenses listed. We don't have any depreciation, depletion, amortization. So we go straight to the changes in our current assets or current liabilities. Okay, so current receivables increase by $10,000. So if we have an increase in receivables, we're going to subtract that increase. Okay, prepaid expenses increase by $2,000. Okay, it's current asset increase, so we subtract. And then we had a decrease in accounts payable, $8,000. Payable current liability, it decreased, so we subtract. So 210 minus 10 minus 2 minus 8, we get a positive $190,000. Okay, 16. Gertrudis Corporation has $10 par value common stock and has 1 million shares authorized and 750,000 shares issued. The entry to record the purchase of 10,000 shares of common stock at $15 per share is. So if they're purchasing 10,000 shares of their common stock, that would be treasury stock. We put treasury stock on the books at cost. So they're purchasing 10,000 shares at $15 per share. So we would debit treasury stock for 150, credit cash 150,000. So the answer there is C. Okay, 17. Which statement regarding the statement of cash flows is true? A, indirect method is preferred by FASB. No, remember the direct method is preferred by FASB, but the indirect method is used by most companies. So the answer is B. Direct method preferred by FASB, indirect method used by most companies. 18. A periodic inventory system. A is used for inexpensive goods. Yes. B requires a physical count of inventory at year-end to determine the ending, should be inventory balance. Yes, because you're not keeping a running total. C does not keep a running record of inventory on hand. Yes. D is not expensive to maintain. Correct. So the answer is E, all of the above. 19. The market value of an available for sale security has increased from the last carrying value. Okay, the journal entry to record this increase will include, well, if the carrying value is increased, that means we have an unrealized gain. We know that we credit gains because gains increase income. When income increases, retained earnings increase. When retained earnings increase, stockholders' equity increases. Okay, so gains are credited. Okay, that means to record this, we have a debit to allowance to value at market. And a credit to unrealized gain. So the answer there is B, a debit to allowance to adjust investment to market. Okay, where would that unrealized gain show up on your financial statements? Well, since this is available for sale securities, the unrealized gains and losses show up on your balance sheet. If it was trading securities, it would show up on your income statement. Okay, 20. The Kendo Corporation has 10,000 shares of 10% $75 par value cumulative preferred stock outstanding and 50,000 shares of $5 par value common stock outstanding. There are currently 2 years dividends in arrears on the preferred stock. The board of directors wants to give the common shareholders a $1.50 dividend per share. Total dividends to be paid to preferred stockholders are. So this question only asks for preferred stockholders. So even though the question says the board of directors wants to pay a $1.50 dividend to common shareholders, doesn't matter. Doesn't matter except for the fact that since they want to pay common shareholders anything, we know they have to pay all the preferred shareholders all the dividends in arrears and the current year's dividends, since this is cumulative preferred stock. So how much are the preferred shareholders entitled to? Okay, well, these are 10,000 shares of preferred stock outstanding. Remember, we always pay dividends on outstanding shares. Okay, this is 10% preferred stock, and the par value is $75. So 10,000 times 10% times 75, 75,000. So we have 2 years of dividends in arrears. These are cumulative preferred stock, so we have to pay these dividends in arrears. So 150,000 of dividends in arrears. Current dividends of $75,000. So we have to pay preferred shareholders $225,000. Okay, 21. Wallendo Corporation issued 5,000 shares of its $1 par common stock as a stock dividend when the shares were selling for $10 per share. At the time of the dividend, they had 100,000 shares of common stock outstanding. These shares were originally issued for $5 per share. The entry to record the stock dividend includes a debit to retained earnings for. Okay, so remember, this is a stock dividend. Small stock dividend, we use the market price. Large stock dividend, we use the par value. Okay, under 25%, small stock dividend. Here they issued 5,000 shares. They have 100,000 shares outstanding. So if we take the 5,000, divide by the 100,000, we see that this is a 5% stock dividend, so it's a small stock dividend. So we debit retained earnings for the market value. So the 5,000 shares times the market value of $10 per share. So we're going to debit retained earnings for $50,000. Before a company can pay dividends to the common stockholders, the owners of cumulative preferred stock must receive, the answer there is A, all dividends in arrears plus the current year's dividends. Okay, 23. On April 1, Allen Company purchased $25,000 of Stephen Corporation's 8% bonds at a purchase price of $96. Allen Companies, whose year end is December 31st, expects to hold the bonds until their maturity date 5 years from the date of purchase. Interest on the bonds will be paid every April 1 and October 1 until maturity. Allen Company uses the straight line method to amortize premier discount on held-to-maturity investments. What is the carrying value of the investment at December 31st? Okay, really, this should probably have dates in it. We'll assume that this is for the first year. So they issue the bond on April 1. They're asking for carrying value on December 31st. Okay, so what is the issue price of this bond? Okay, well, this bond was purchased at 96. Maturity value 25 multiplied by 96%, get 24,000. Okay, so total discount is 1,000. Okay, we're going to straight line amortization, so we take this discount, divide by the number of interest periods. So these are 5-year bonds. Interest is paid semi-annually. So 10 interest payments, so $100 each interest payment. Okay, so on October 1, we would have amortized $100 of this discount. Now we have to figure out how much we would have to accrue on December 31st. So we have October, November, December. So 3 out of the 6 months. Remember, interest is semi-annually, so 6 months in each interest period. So we take that 100, multiply by 3 over 6, and get 50 by December 31st. So at the end of the first year, we've amortized a total of $150. So again, carrying value is that maturity value, which is $25,000. Minus the unamortized discount, we start with 1,000. By December 31st, we amortize $150 of the discount. So the carrying value is $24,150. Using the aging of receivables method to estimate uncollectibles, Avidity Corporation estimates that $3,550 of its accounts receivable will be uncollectible. Prior to adjustment, the allowance for uncollectible accounts has a credit balance of $800. Uncollectible account expense to be reported on the income statement is. So remember, aging of accounts receivable method calculates your ending balance and allowance for doubtful accounts, or allowance for uncollectible accounts. Okay, they tell you in this problem that the aging estimates that $3,550 of accounts receivable is uncollectible. So this gives us our ending balance and allowance for uncollectible accounts. Okay, they tell us that the beginning balance in this account had an $800 credit balance. We're looking for the amount that goes there, the amount of uncollectible account expense. Because remember, when you record uncollectible account expense, you debit uncollectible account expense, credit allowance for uncollectible accounts. So 800 plus that expense equals your ending balance of $3,550. So the amount of expense is $2,750. Okay, 25. Given the following data, what is the value of ending inventory as determined by a FIFO? Remember, FIFO, cost of goods sold, is the first items in, which means ending inventory is the most recent items. So goods available for sale is the beginning inventory of 120 plus purchases of 240. So goods available for sale is 360 units. Okay, they told us in the problem they sold 300 units. So that means ending inventory is 60 units. Again, FIFO, cost of goods sold, was the first items in, which means those ending inventory is costed at the last items in, so those purchases. So we take the 60 units multiplied by the $10 per unit, we get $600 under FIFO. During the current year, the Hampton Company purchased 200 shares of Hilton stock for $15,000 as a short-term investment in available for sale securities. At the end of the year, the market value of the stock was $11,000. Okay, their financial statements for the current year will show, again, available for sale securities. At the end of the period, we mark the securities to market. So on our balance sheet, the stock will show up as $11,000. Okay. When we mark the securities to market, we would show a $4,000 unrealized loss. Since this is available for sale, that unrealized loss goes on the balance sheet. So the answer is A, an unrealized loss, $4,000 on the balance sheet, and short-term investments of $11,000 on the balance sheet. 27. At the beginning of the year, prepaid insurance had a balance of $6,500. At the end of the year, the balance in prepaid insurance was $7,900. Insurance expense, as reported on the income statement, was $49,500. Payments for insurance during the period amounted to. Okay, so again, you kind of do shorthand, longhand. Start with insurance expense. $49,500. Again, this is an expense, so you start with a negative number. Then adjust for the change in your prepaid insurance. So beginning balance $6,500, ending balance $7,900. So it increased by $1,400. If it increased current asset, do the opposite. So if it increased, you subtract. It's going to be negative $50,900. Okay, so a cash outflow, $50,900. If you looked at your T account, Okay, we had a beginning balance, $6,500. Ending balance, $7,900. Okay, when you recorded insurance expense, you would have debited the insurance expense, $49,500, and decrease your prepaid insurance. You're looking for the amount that goes there, the amount of cash that you paid. So when you pay cash, it would increase your prepaid insurance, decrease your cash. So $6,500 minus that $49,500 plus this X minus the ending balance of $7,900, you get the $50,900. Okay, 28. Renew Corporation had accounts receivable of $90,000 at the beginning of the year and $100,000 at the end of the year. Sales on account for the year amounted to $465,000. The amount to be reported on a statement of cash flows under operating activities is. So again, shorthand, we start out with sales on account, so $465,000, positive number because it's a revenue number, just for the change in accounts receivable. Okay, so beginning balance $90,000. Ending balance $100,000, so it increased by $10,000. Increase of a current asset is subtracted, so we get positive $455,000. And if we looked at the T account, okay, beginning balance $90,000, ending balance $100,000. We recorded sales on account. We debited accounts receivable for $465,000, credited sales revenue. That goes on our debit side. We're looking for the amount there. So when we collect cash from customers, we debit cash, credit accounts receivable. So this amount that we need here, $455,000. 29, which of the following best describes a liability? Okay, just a definition of liability. The answer is the debts payable to outsiders called creditors. Okay, 30, a $3,000 7.5% bond is quoted at 97.5. When the bond is issued, the bond's payable account will be increased by. Okay, this question only asks for bonds payable. What would be the whole entry? Well, this bond was issued at 97.5, so that means 97.5% of the maturity value, so $2,925. Okay, so when we issue this bond, we would have debited cash for the amount that we received, $2,925. We'd have discount, bonds payable for the $75 discount. Then we would credit bonds payable for the maturity value of $3,000. So this question asks the bonds payable account will be increased by, the answer is B, $3,000. 31. Abler Company owns 40% of Sapporo Company. Sapporo Company paid $40,000 cash dividends for the year. Abler Company's journal entry to record the dividends includes. So this is 40% ownership. We use the equity method to account for this investment. Under the equity method, receipt of dividends decreases the investment account. So here, we receive, the investee pays $40,000 of dividends. Company owns 40%. So they receive $16,000. Okay, so the entry is going to be debit cash for the amount that they receive, but then the credit is to the long-term investment account. Okay, because receipt of dividends is considered a distribution of the investment under the equity method. 32. On December 15, 2010, a company receives an order from a customer for services to be performed on December 28, 2010. Due to a backlog of orders, the company does not perform the services until January 3, 2011. The customer pays for the services on January 6, 2011. Matching principle requires the revenue to be recorded by the company on. Should really say revenue recognition principle. But in any case, you're asking for when the revenue is recorded. Revenue is recorded when the services are performed. So that would be January 3rd, 2011, A. Okay, 33. The purchase of a held-to-maturity investment would appear on a statement of cash flows in, this is an investment, so it appears in the investing activities section, C. 34. Accounting information is subject to the constraints of, answer there is A, materiality and cost. 35. On January 1, 2011, Centurion Corporation purchased 40% of the outstanding stock of Street Kings Corporation for $750,000. Net income reported by Street Kings for 2011 was $110,000. Dividends paid during 2011 were $65,000. The long-term investment will appear on Centurion Corporation's balance sheet in the amount of. So 40% outstanding stock, equity method investment. So we increase the investment account by our portion of the investee's net income, decrease the investment account by the percent of dividends. So we start out with what they paid for it, so the $750,000, and we increase by the percentage of investee income. Okay, so if we own 40%, they reported net income of $110,000. So 110 times 40%, so plus $44,000. And we subtract for the percentage of dividends, the amount of dividends received. Okay, so they have dividends of $65,000. So we take the $65,000 multiplied by 40%. That's $26,000. So $750,000 plus $44,000 minus $26,000, get $768,000. 36. On August 1, 2011, Tyler Corporation issued $3 million 10-year bonds dated August 1, 2011 at 101 when the market rate of interest is 8%. Tyler Corporation uses the effective interest method of amortization. Interest is paid each January 31st and July 31st. Assuming the company's year end is March 30th, the entry to record the first semi-annual interest payment on January 31st, 2012 will be. So here, effective interest method, so we're going to take the carrying value times the market rate of interest. So these bonds are issued at 101. Take the $3 million, multiply by 101%, get issued at $3,030,000. For the first interest payment, our carrying value is the $3,030,000. Multiply that by the market rate of interest. It's 8% per year, which means 4% per period. So we get interest expense of $121,200. So the answer is B, debit to interest expense for $121,200. Okay, in this question, that is the only information, that is the only thing that you can solve for. The problem doesn't give you the stated rate of interest, so you can't solve for cash paid for interest. Since you can't solve for cash paid for interest, you can't solve for the amount of the premium that is amortized. 37, Calcide Company signed a 15-month, $50,000 6% note on June 1, 2011. The amount of interest to be accrued on December 31st, 2011 is. Again, that 15-month, we don't need to know that since the question is asking for amount of interest in 2011. We would have to know that this was a 15-month if the question asked for December 31st, 2012, because you'd have to know how many months were left in 2012. So in 2011, we just take the principal of $50,000 times the annual interest of 6%, multiplied by the number of months outstanding over 12. Okay, so this is signed on June 1. So if we go June to July 31st, it's 7 months. So we multiply that, we get $1,750. Grape Farms Company sold some fully depreciated equipment for $4,100 cash. The equipment had been purchased for $49,600, and the company had estimated the useful life of 8 years and a residual value of $5,600. How will the sale affect retained earnings? Okay, well, what does it mean for a piece of equipment or something to be fully depreciated? Okay, remember that means we've taken all the depreciation we're going to take. What is the depreciable cost? Depreciable cost is cost minus the residual value. So when we have a fully depreciated asset, that means its book value equals the residual value. Okay, so the residual value here is $5,600. So book value equals $5,600 on the date of sale. Okay, here we sold it for $4,100 cash. So remember, the gain or loss equals the cash received minus the book value. So if we receive $4,100, but the book value is $5,600, that means that we have a loss of $1,500. So a loss of $1,500, the answer is D, will decrease retained earnings by $1,500. 39, a company has a contingent loss that can be estimated and has a probable chance of occurrence. What reporting does the FASB require regarding this contingency? The answer is A, should be accrued and reported. Remember, if it's probable and can be estimated, it's recorded. If it's probable but can't be estimated, or if it's only reasonably possible, it's reported in the notes. If it's remote, not reported. What about a contingent gain? Never report contingent gains. Okay, 40. Last question. On January 1, 2011, Ryder Corporation purchased 30% of the outstanding stock of Arapahoe Corporation for $770,000. Net income was $120,000. Dividends paid by Arapahoe were $70,000. The amount of investment revenue that Ryder should recognize is, so this is equity method investment. Remember, investment income for equity method investment is the portion of the investee net income. So here net income was $120,000. Own 30%, so we take $120,000 multiplied by 30%, $36,000. Okay, remember, investment income for those passive investments available for sale or trading security sorry, too much chalk. Is the percentage of dividends received. Okay, better. Any questions on the practice exam? One thing I will say for the practice exam, I did notice while going through, there wasn't anything from Appendix C. You are responsible for Appendix C. You will have the present value tables in your exam just like you did for the second exam. So make sure you study that and don't leave that off. Okay, any questions?
There's one of the answers in the back that was wrong. There's number 27, back
Yes, there was one, if you printed it off prior to yesterday. What was that? Number 27? 27 had the wrong answer. It has since been corrected online. So the answer that we just went over and what is posted there now is correct. Thank you. Any other questions? Okay. See you on Monday.